with Now. Never miss a thing with MDN TV, the podcast. We love to keep you in the present with diverse goodies from secular and non-secular subjects of global interest. Join us. Grab more from these series. Listen to our podcasts. The undeniable choice.
It's sundown. The day has just begun. Good morning, good morning, good morning, everybody. Yes, this is MDN Shows Running with the Times, only on MDN TV, the podcast. And I am Major Daughter. Welcome to all our listeners and viewers around the world. Meet us in the comments. We are live there. Share your thoughts, ask questions, share this broadcast. Share this podcast. Tell your friends to tell their friends that it's happening right now. Tell you what, 2023 is around the corner, and it's either you make it in business or you break it in business. But all that depends on how you prepare for it. I mean, we have heard about the financial crisis that is coming or it's impending. We have heard about the recession. Look, to some, bad news is actually good news. Do you know why? Because they have prepared themselves. How prepared are you? Oh, maybe I should rather put it this way. Have you prepared yourself for what is coming? So today, we're doing something different. My guest is a founder, but also an investor. And he's a founder of Invest on Main Street. So he's all about investment. Some of you are into real estate. Some of you are into crypto. Some do the Forex. Whatever it is that you do, here's an opportunity to learn about passive investing. Have you ever heard of money working for you while you're sleeping? Money working for you while you're away on holiday? Well, that's exactly what we are talking about here today. Is it even possible to make profit from day one of buying property or investing into real estate or whatever investment? We'll look at all these different kinds of investments with my guest, who is very, very experienced in this. He's going to take us through step by step. He's also authored a book that I'll suggest that if you're really serious about investing, serious about really making profitable investments, get the book. Is on Amazon. It's called Persistence, Pivots, and Game Changers, right? You want that book so that you can prepare adequately. And what I heard from him before this show started is that the book is available for free. You can get it for free. Now, all the details for the book, the title, and the links are in the description. If they're not there, ask for them. Okay? So we'll make sure that everything is in the description. If it's not there, ask, and it shall be given. I'm also thinking, how does one find deals in this kind of a climate? I mean, we're heading to recession. You hear talks of crisis, talks of financial crisis. There's a lot going on. Is there light at the end of the tunnel? Or are we the light inside the tunnel? Well, let's all find out right after this.
MDN TV, the podcast. Be abreast with Now. Never miss a thing with MDN TV, the podcast. We love to keep you in the present with diverse goodies from secular and non-secular subjects of global interest. Join us. Grab more from these series. Listen to our podcasts. The undeniable choice.
The undeniable choice indeed for today is Patrick Grimes. I mean, how can investors protect their wealth from rising inflation and drive greater returns in a very inflationary environment? Patrick, thanks a gazillion times for saying yes and for availing yourself and your wisdom. You are a founder and CEO of Invest on the Main Street. Really? Now, I've already raised a question. Please take this opportunity to greet our listeners and viewers around the world and tell us if it's possible really to protect our wealth as investors in a climate like this one. Rising inflation, increasing interest rates. The list goes on. Patrick, the mic swings to you now.
All right. Yeah, I appreciate you having me here, Major Daughter. And that was an amazing intro. Awesome show. Excited to contribute what I can to your audience. So I'm Patrick Grimes, founder of Invest on Main Street, and that's what we do. Actually, you teed me up right to my sweet spot. We invest in investments that provide cash flow and appreciation, monthly passive income. And while even recessions happen, in fact, I lost everything in 2009 and 10 when the big housing crash happened in the United States. And as a result of that, I've been living in this world where I think that it might happen again potentially. So I've structured deals, not just in real estate, but also in diversified energy funds and other things together for passive investors to join us, where you have some hedging against inflation, where you have some safety from rising interest rates. And we could certainly go into various mechanisms and ways we do that.
Absolutely. And thanks a gazillion times once again for saying yes. Look, before we even do that, you have written a book, and I want to make sure that we have captured the book correctly. What is the name of the book that anyone can get for free to really understand and prepare adequately for what is coming, for what is happening, for this present climate? Patrick?
Yeah, sure. The book's called Persistence, Pivots, and Game Changers, Turning Challenges into Opportunities. And I was very excited to be involved with this book because I came from, while I'm in real estate and energy right now, and we have a 500 million portfolio, I came from just being an engineer working at a design firm. And I worked my way through that into real estate, lost it all back into real estate, and scaled up my portfolio, and then diversified into energy and a number of other things. And I tell that whole story in this, and I joined together with some other people that are really cool. There's Phil Collins, lead guitarist of Def Leppard. There's a bunch of other NFL, NBA players, all kinds of really fun people in this book. And so yes. It did make an Amazon #1 bestseller. And you can go to our website, investonmainstreet.com/book. And if you fill that form out, I do send out a signed copy.
That's beautiful. So what inspired you to really go for or take on a journey on investing?
It's a really good question. So when I came out of my mechanical engineering degree, I jumped into machine design, automation, and robotics, and I love it. I mean, to this day, even though I don't do it anymore, it excites me just talking about it. I was medical devices, solar cells, EV vehicles. We were putting together some incredible things, doing one-of-a-kind designs. But the owner of the company said, hey, Patrick, while this high-tech space is cognitively rewarding and a lot of fun, it's not where you want to put all your eggs. You want to invest as much as you can and as early as you can into real estate. And I took that to heart, and I definitely saved up as much as I could, put it into some investments, and I didn't understand risk at the time. I just understood high returns, and I did through 8, 9, and 10 lose it all. But I didn't let that weigh me down. I went back into my engineering career, got a master's in business and a master's in engineering, started doing well again, and then got back into it, but recession resilient investments that cash flow, and then traded those up to large apartment buildings and also into the energy funds that we're in.
Wow. Now we are approaching a recession with inflation, but there's also interest rates that are rising. In fact, in our country, South Africa, they've just hiked the interest rate. Is this the perfect time to seek a haven for our investments, our money, our wealth? Or what will you say? What are your thoughts really even on the rising interest rates? I'll tell you why I'm asking that. During the hardest lockdowns and at the peak of the pandemic, there was a cut down and a whole lot of cut down on interest rates. So can we say we are now having that reversal, or not at all? There's no reversal taking place. What are your thoughts on that, Patrick?
Yeah, over the long haul, you see that the economy goes through an expansion and then a contraction, then an expansion and a contraction. And that's actually, if you talk to economists, that's kind of the nature of capitalism. They start very positive about the economy, start lending out a lot of money, which grows the economy, but that can lead to inflation. So although we did have a COVID situation, a bunch of money was printed, which started to inflate things. And they did drop interest rates to stimulate it at the same time, which kind of compounded and aggregated that. On the other side, it's just a textbook play. The Fed in America continues to do a very good job of stabilizing inflation by raising interest rates, by slowing the economy down. And as unfortunate as it is that people tend to lose jobs, it's just part of the economy that we have, that it does tend to get a little out of control and it needs contraction. And in this particular case, they're going to keep rising interest rates until, just like in years past, until inflation gets under control.
So how does one really protect their investments from the rising interest rates? As you say, they're just going to keep raising the interest rates. It's not going to stop. How does one really protect their investment, but also take advantage of what is going on, if that is even possible?
Well, so we're doing that in pretty much both of our asset classes, our primary asset classes right now. One is on large apartment building investing. And what you found in that space is that through COVID, people struggled. People struggled that that got really big loans and didn't have a lot of cash flow. And when people stopped paying, they went underneath it and weren't able to pay their bills. And if anything else happened, like a natural disaster, then they were distressed. Maybe also they had short-term interest rates, short-term loans that are coming due. And right now the values aren't there and they can't refinance. And so they're distressed. So we're seeing a lot of deals come up to acquire as a result of the down in economy. And because of that, sure, there's great opportunities to buy, but only if you structure it correctly. And like you said, we can put together long-term fixed debt projects or debt with interest rate caps that we purchase. So we're protected from interest rates. And if we're buying a multifamily building, apartment building that cash flows and has rents, well, those rents tend to track with inflation. And sure, our expenses do too, but that's a hedge. And that means we're either breaking even or we're making a little money with inflation. And so there are assets out there that provide that protection, that capital preservation, while hedging against interest rates and inflation. And it happens to be that our workforce housing, existing construction, 200 to 300 unit apartment buildings are one of those. But our energy funds are one too. In fact, our energy fund has no debt. It's all cash. So if you're going to protect yourself from interest rates, then get into a deal that doesn't take on any debt. So who cares about interest rates? And energy and housing are in completely different market cycles. Right now, housing interest rates are going up and cash flows are going down and valuations are waning, right? We're in a reset. But in energy, it's not the case. In fact, nationally here in the United States, it's growing. Why? We see OPEC dialing back how many barrels they're producing, Russia misbehaving, and so Europe's pulling out of natural gas from Russia, which is stimulating energy national drilling here. So we're on an expansion curve. So we're invested. If you're invested into both of these, you can be growing in one, the other shrinking, and then so on.
Wow. Mind blowing. I'm just thinking, with all that you have said, how does now one find deals during this present climate? And where are these deals? Not just how, but where do we go look? Patrick?
Well, that's kind of there's a couple things I can say there is it's very tough if you're just starting out right now and you don't have any experience to dive into an industry and know it through and through enough to and have a long-term relationship with individuals to find those distressed deals and to then survive and navigate this economy and to get the debt I'm talking about. It's challenging for you, as if you're going to be an active and try and do it yourselfer, this may not be the best time to just start out, potentially. Same thing on the energy deals. Oftentimes, our investors don't have the knowledge, the network, or the resources to just go do that themselves. It's a lot of moving pieces, and there's a lot to learn. And so I recommend you put your trust in people that have a decades track record, that have proven success. Because if you passively invest with experts that have already implanted themselves into these markets that are recession resilient, in these investments that are inflation hedged, and they've shown to be able to perform, that allows you to find that great deal, invest passively through a firm like ours, get great tax advantages, great monthly passive income and appreciation. And you know what? You're not trading time with your family, friends, and hobbies. And
yes,
you don't have to lose it all like I did, trying to get into an industry that I didn't fully understand in the middle of a reset like I did in 2009 and 10.
Yeah. And talking about passive investment, because you want to have your money working for you. You want to have money running around for you. But what does it look like for someone who has never seen anything or heard anything on passive investment? What does it look like, and how can one get started on passive investment?
Yeah, it's a really good question, because especially in America, there's no education for this. In fact, if you know the requalified retirement plans that your employers give you, pretty much they're 401k IRAs, and that's mostly what anybody knows. Maybe they've graduated to make enough that a financial planner will work with them, and maybe they only know about that. Maybe they're dabbling in some day trading in the stock, but all of these are all in the stock market. They're all in the trade. So they're going to follow the same curve. So how do you get started outside of that, right? Because in those, you're just riding up and down the stock indexes, and you're taxed, you're non-inflation hedged. And if you do save enough to retire, you're going to dwindle it down. So graduating from there to a non-correlated asset like real estate, where you have tangible, inflation hedged real property, and diversifying from there into energy, where you're in another essential need, those are really hard to find. And so on our website, for example, Invest on Main Street, the reason why we named our company that was to do the best we can to raise the financial IQ of investors. And on there we have, my wife put together 70 videos that are daily educational videos. I write for Forbes, got a bunch of articles. I do lots of educational webinars. We have the book. So I recommend jumping on there and just kind of get exposure to what are called private investments or private placements that allow you to invest in these kinds of assets directly in a way where you can have capital preservation, cash flow that allows you to retire earlier, not pay taxes, and then retire while living off the interest and not that dwindling down.
Yeah. I want to quickly run to the real estate, but also because what you're saying, I mean, my head alone is bubbling because this is just something else. But before we go to that, you say passive investors are using 1031 exchanges to build wealth. What do you mean by that, Patrick?
Yeah, sure. Well, when I lost it all, my first real estate deal, I got back into it. I was buying existing construction, single family homes that existed, and I was making small, measurable improvements. Yes. And then I would rent it out, and then I'd buy another one, rent it out, buy another one, and rent it out. But then I realized after I spent all that time to find it and I fixed it up, I got a great deal. And it made a good return, but then I just held it, and that return didn't change. It just leveled off, and my IR went down. I realized I had to get rid of that property, put that equity into another deal where I could lift it up again, and another deal where I could lift it up again, and continue to drive that. And so in order to trade from one property to the next, you have to sell it, pay taxes, and then buy a new one, which means you take a step forward, a step back, step forward, step back. Or you can do in the United States, which is called a 1031 exchange, which allows you to take a property, it allows you to sell in a way where you trade it without paying any taxes into the next property. And so I consider it to be one of the most powerful tools available to Americans. And we help people all the time sell their rentals and invest that through a 1031 exchange to be partners with us into our alternative investments.
So what you're actually saying is that is your advice that people should not keep the rentals, they should sell the rentals and take that into another property, or what are you saying? I want to be sure that I'm capturing you well.
Well, so when I was doing that and I was working my high-tech career and I was buying properties and I was finding a deal, renovating a deal, and then finding another, renovating another deal, I was moonlighting that. And it was hard. In fact, when I met my wife, she was there for my very last single family closing. And I said, look, this is the last one because I can't moonlight my investment career and also marry you. And so she was there, and I said, look, after this, we're trading up to larger assets. We're going larger apartments. And so then when I said, well, these investments, they're cash flowing, but my equity is really big. And if you look at my actual cash flow for my equity, it's small. But if I was to take this equity and I was to 1031 exchange another deal, then I would get a proportional cash flow. And I'd be able to improve that deal. And so, it makes more sense to continue to drive your appreciation, continue to drive your net worth, to trade these forward as opposed to just hold forever. And although that's a huge job, I mean, if you've already got a job, that's another job.
Yes.
So I
full
say
time.
1031 exchange. Yeah. So I say 1031 exchange if you can trade it into a partnership in a firm like ours, where we have inside property management, we have regional and area management. You don't have any jobs left. And we're finding deals you couldn't find, and we're renovating them, and we're getting your capital back, and then we're trading forward. So if you can do a system like that, it doesn't make any sense to keep those rentals.
Wow, and that can be done anywhere. Is it even possible to start investing in property if you don't have money? Can that be done? Well, welcome back. If you have just joined us, we have Patrick Grimes. I mean, he's the CEO and founder of, he is big on investment. He's really big on investment, and he's a CEO and founder of Invest in the Main Street, or on the Main Street. So he's all about investment, and we're talking passive investment. We're talking real estate investment. And before we went to the break, Patrick, I was about to ask you, how does one really start investing in property if they don't have money or any money? Is it even possible to get started on real estate with no money, if you know what I mean? Patrick?
Well, first of all, I just want to point out that there's a lot of gurus out there that are saying, oh, go get it, no money down, buy your first property on credit cards. And I tell you what, I don't buy into any of that. Because those mechanisms oftentimes put you in a very precarious situation where you've got a ton of debt and you don't have a lot of cash flow. So I'm not a big fan of that. What I am a fan of, though, and like I did, I worked hard. I was a mechanical engineer. I got a master's in engineering and I have an MBA. And I worked hard to make money and then save. I saved once and then I lost it all in 9 and 10 through pre-development, more risky deals. And I saved again, and I bought my first single family. Then I saved again, and I bought my second. But I'll tell you what, how I got into larger multifamily deals was I found other people that would let me work with them. In fact,
Yes.
my first apartment building, I didn't ask them how much I was making. I did a lot of work. I flew around, I walked the units, I underwrote, I did analysis on rental comps. And it took me about 2.5 years of a little bit of analysis paralysis, because I'm an engineer, not that long for everybody. 2.5 years of just working hard and proving myself to other players and learning as I went to where they were finally, hey, let's do a deal together, right? And then I got into a whole industry that I wasn't. I went from 3-bedroom, 2-bath. My next one was an 86-unit apartment building. And it was just grit. It was just persistence, like what my book has here. And I talk about that in the book. If you'd like a copy at the end, we'll tell you where to go get it.
Now, you are incredible because you have also been able to raise millions of dollars for your deals. So here is the $1 million question, Patrick. How does one find, it's $1 million question for someone who has raised millions, right? In dollars. How does one find investors to invest in their own deals? Is that even possible?
Well,
Patrick?
yeah, sure. It is possible. And I couldn't believe it myself. In fact, when I was doing my first round of deals, it was all my own money, and I felt like I needed to control it all. I needed to do my own money. I couldn't risk anybody else's money. But meanwhile, I was doing this high-tech business. I was doing custom machines, one-of-a-kind inventions that sometimes didn't work out. And people were giving us many millions of dollars for very risky ventures. And it was funny because when I finally, people started hearing what I'm doing in single family, they're like, wow, that's so cool. Then they saw that I was doing apartment buildings, and I realized I could offer them an opportunity to partner on a much lower risk option, not business, but personally, that gives them a legacy, that gives them cash flow, tax advantages, safety from recessions and interest rates. And you know what happened? Those high-tech guys, they jumped on board. And the first raise I raised, I think it was $650,000 just from people that I'd known for 10 or 15 years.
Yes.
And after that, I started branching out.
If you don't mind me asking, when you're raising this money or these investments, what does your pitch look like? Because that's something that is probably on many people's minds right now. That you said you started with people you know. Well, who are these people? Could this be my friends? Could this be my parents? Could this be my accountant, my bookkeeper, my attorney? Patrick.
Well, none of those actually were in the first round because I didn't go family and friends, like close
Yes.
personal friends. I didn't go to accountant. I didn't go to my bookkeeper. I went to my professional
Okay.
colleagues, right? Yeah, that had built a reputation with through my automation career. But I'll tell you what happened after I started getting some success. Friends came and asked me, "Hey, what the heck? How come you haven't asked me?" And that kind of that reverse drew in. But my career is a little different. I do for accredited investors in the United States. My investments are it's a little bit of a high bar. To invest with us, it's you have to make 200,000 a year or 300,000 a year, or have $1 million in net worth, and that's the way we file with the Securities and Exchange Commission. So, and that's how I've done all my deals, 100,000 minimums. With those requirements for investors. So that does rule out a lot of, some of the closer friends and family, but it brought me to a level of sophisticated investor or individual that could understand and appreciate and intelligently assess the risks. So my pitch was very different. It wasn't, hey, because you love me, you should trust me and do this deal. My pitch was, hey, here's the metrics and the valuations and the cash flow and wealth building mechanism that I'm presenting to you now. Does this align with your portfolio? And so I went from it kind of from that angle, and I didn't really tap into the, call it friends and family network like a lot of people do.
And I guess those may never even really help those ones. And look at what you have just done. It's a wow. Come to think of it, it just turned everything around. Now, what do you think are some of the biggest mistakes that wannabe investors or young investors are making out there?
Well, yeah. So since I've been through a downturn and I've seen how the economic models can break down, and I've seen how demand can shift, I look at deals very differently than a lot of individuals. In fact, I've flown all over the place to look at people's deals. They want me to be involved, and I've just asked questions. They didn't even understand the question. And it's because they haven't looked very deeply into what I like to call stress testing, or making it resilient to economic swings. So I like to make sure that my investments can survive another 2008. And if it can't, I don't think the deal should be done. That means you have to put up enough down payment to make sure that you can float it, even if 30% of the people stop paying rent. That means you need to have reserves on the sidelines to make sure that you can float a property in case a tornado hits. That means you need to have insurance to replace the rents and the income in the case that happens, to make the investors whole. And what happens after all, and you need to pay for fixed interest or long-term interest. So you need long-term investors, not short, quick wins. What happens? The returns lower, but they're more stable returns. And I believe it's the tortoise, not the hare, that wins the race. I don't know if you have that in South Africa, that analogy or not, but that's the mistake a lot of people make, is to think too short term, like I did in 2009 and 10. And it took me several years to crawl out of that.
Absolutely. It's the same everywhere. But how do you evaluate a deal?
So I just like the terms that I just talked about are the way that we structure financially the investment, right? But when we're evaluating investments, we look at kind of two other things, mostly the market. And a lot of markets out there in the United States, for example, like Las Vegas or Orlando, are huge in hospitality. So not a big fan of those, because if you look at the past data, it took like 10 to 12 years for those to even break even after 2008. And like in Detroit, where it was all heavy in one industry like automotive, still struggling. So I look at markets that fared well in past recessions, and I look deep into, when I talk on economics on stages about this, I look deep into the employment in those markets. And you want to see some very recession resilient employers, because it's really the employers that are paying you through the residents. And so if they're healthcare, education, logistics, finance, and you have a bunch of recession resilient pillars that have built-in insulation, you have that market. Now, if you find that kind of market, and then you find one that's expanding and growing for the right reasons, they have a legislative friendly. That means they're attracting businesses. That also means they're friendly to landlords. They're low cost of living. They're friendly to people moving in. They have a high quality of living. And population and job and income growth are growing, which means vacancies going down. If you do a deal, it's recession resilient in an expanding market that's landlord friendly and tax advantaged, you're going to be riding a tide. Now, if you got to find a good deal so that your returns come even in a reset. But like what we saw in Houston, is that slow, steady curve of the valuation growth in Houston. But then when 2008 and 9 happened, it leveled off. And then it went up again. Now, how did that happen? Where all the other markets had these dramatic swings? Well, in Houston, it had expansion. So when the market leveled off, the expansion actually caused the net to equal and then went off. And so if you can find a market like that and structure it properly, then you'll find a win in any economy.
Yes, we live in a world where people want instant miracle. They want instant riches. Everything must be instant. I mean, with the microwave, where you can just take your food, put it there, and it's ready, within few seconds. Even on investments, that's how people are looking at things. And here's my question. Is it possible for one to make profit from day one of buying property or from day one of investing? When does one really start making profit? Patrick?
Well, profit's viewed differently by different people. And it takes a while to get your money back to then maybe make profit in some real estate deals. But I consider cash flow profit if you're buying a safe investment, because your net worth is growing in that and your cash flow is upside of that investment. And so the Robert Kiyosaki Rich Dad Poor Dad book that I read when I was younger and contributed to my journey says buy for cash flow. And that's what I didn't do in 2009 and 10. I bought new construction, new development, hoping to develop land, hoping to build on land. And you know what? The market fell apart and I was stuck paying out of pocket until it ruined me. But if you buy for cash flow, you can profit right now. In fact, we have investments on our website today where if you invest in less than 30 days, you start receiving monthly passive income. You don't pay taxes on it if you're United States residents, and they provide immediate appreciation. So your value grows, your net worth grows over time. So those can happen. It's not far off from our energy deals as well, because you immediately begin cash flowing and within a short period of time after you invest, and you appreciate as well. So you can, I believe, profit on day one, but you got to be patient, because it's not going to be profit that's going to double your money every 2 years or even every 3 years, especially in this economy. You got to look at people projecting out reasonable returns in 3 to 5 years, maybe doubling your money.
This right here is music to our ears. Look, what's your number one tip? And we're almost at the tail end of our show, but I've got two more to throw in. What's your number one tip for being more efficient with your investment and getting better results with less effort, if there's such a thing, without lifting your finger, really?
My number one tip without lifting a finger, well, I'll tell you what, I'm a hard worker. And so I've always been that way. You know, I was high tech worker and then moonlighting real estate. Then I was a high
Yes.
tech worker getting 2 master's degrees. Then I was a high tech worker doing large in real estate and oil and gas. Now I just do real estate and oil and gas. But I'll tell you what I'll say. A couple things. I've already talked about be the tortoise, not the hare. Be patient. I've talked about buying for cash flow. What I'll say is to partner. Because what I realized when I was trying to do everything all by myself, I wanted to control it. I was worried about partnering because I was worried about what they were going to do and whether I agreed with it. And then what it left me with is having to do all the jobs in an investment. It's like a cross-functional group of people. It's like saying, hey, I want to go start a factory all by myself, right? Because there's so many cross-functional people required in a factory. And you don't want to do most of those jobs, right? Just why don't you partner with people that have a long track record and knowledge and a passion for doing the piece of the puzzle that they're doing, and that fits with the piece of the puzzle that you want to do, that makes you want to get out of bed in the morning. And trust, but verify. It took a long time for me to find the right partners and had to dig pretty deep below in order to get there. And sometimes I had to, shift around. But I did find long-term partners. But once I partnered up and I found these synergies between other people that were like-minded, tortoise, not the hare, risk profile, life became easier. And quite frankly, it became a lot more fun because they call me excited about doing something that I really hate doing. And I get to call them excited about doing something that I love to do and they don't want to do.
Do you feel you took long to get to where you are today? And if you had to start again tomorrow, will you do the same things that you did, or will you change your strategy, Patrick?
Yeah. So, I mean, I don't have any regrets because my life's been fun and exciting. And I've even traveled the world a couple times. So I've been and done a lot of crazy stuff. We lived in Hawaii for several years during COVID here, but so we've done a lot of amazing things. So I don't have any regrets. But I would say is those attributes that I talked about being persistent, not putting all your earnings into just a retirement account, working hard to find other ways to diversify, and trusting in partners, working with others, and keeping your superpower, the thing you want to do, what you do, and finding other complementing ones. I would partner sooner if I was to go talk to my old self. Because if I had, maybe my partner would have explained to me, hey, here's all the risks of this development deal. Maybe don't put everything you got in it. and maybe, if I would have partnered through single family, I would have been a lot better off, and same thing in multi. So it's, I'd say partner up sooner. And that goes for passive investing, right? Partner with somebody that knows how to do it so you can go enjoy your family, friends, and hobbies, and you don't take as much time away from them as I did when I was trying to do it all by myself.
Well, maybe now that you mentioned that, there you're talking about active versus passive, right? What are the pros and cons of active versus passive investing? There's some people who want to be hands-on whatever that they're doing. And I don't know what you'll have to say about that. Yeah,
well, I have Forbes articles. I write for Forbes, and I write several on that topic. There's one out there, Patrick Grimes Forbes, do-it-yourself single family versus multifamily. Talks about this do-it-yourself single family guy buying houses, flipping houses, doing it himself, what I used to do, versus the alternative of passive investing. And I have other ones on asset protection and single family versus passively investing as well. I think what the gurus aren't telling you, the people that are in the TV shows that make it very glamorous to buy a property and flip it and make a quick buck, those, unfortunately, what they're not telling you is what happened to me is I was buying these houses in my own name, and I was signing on loans in my own name with my own credit. And what happens is that I was taking risks, not just with the investment I used for the property, but I was taking risks because I was personally guaranteeing the loans with everything else that I had. And that's called cross-collateralization. And every investment was cross-collateralized with my own assets. They don't tell you about that. Also, people can trip and fall, and they can come to you and sue you because you're on the name. And so that's a risk. Now, some people try and put them in other LLCs and companies, but then the lenders don't like that. And then they can call your loan due. So there's really hard to get protection in that space, in the single family, small fix and flipper or buy and holder space. So I just be careful of that. I'd say that's kind of the drawback. And if you passively invest, and we're a securities offering, so you're protected. You're a limited partner. In fact, we sign on the loans. You don't have to deal with that. We sign on everything. You don't sign anything. You're limited to the investment you have in there, and we get that back to you pretty quick. You can invest it somewhere else. What happens when you invest it somewhere else? This asset is completely isolated from this one, the other one, the first one, and it's completely isolated from you. And when you do another one, it's isolated again. And so I think that you can set up a diversified support portfolio quicker in the other areas, not just nearby you. If you go passive, and you're protected from them, they're protected from you, and they're protected from each other. Can't do that scaling a single family portfolio.
Yes, and I'm thinking, how can people manage their investments and avoid continually jumping from one investment or one type or method of investing to another or to the next?
Yeah, so how can they manage that? Well, it's tough. It's tough. It's hard to be the expert of everything. And if you're already somebody who has a job, like most of my investors, they're high performing professionals.
Yes.
They're doctors or they're lawyers or they're business owners, high tech professionals, and they're busy. They're doing something they're passionate about, they're good at, and they love, and they're the expert in that field. And they're used to being the expert, and they're used to being in control over their little microcosm. But then all of a sudden we're like, hey, you need to diversify. You need to be in this other thing that's completely different. And it's called a non-correlated investment, something that's different than what you're doing. And then you need to be in more of those, and more than one. And I'm saying you need to be in real estate, you need to be in energy, and we've got some other ones. But you're not going to know everything about all of it. It's impossible. And by nature of them being different, meaning that you're going to have to step in with some faith. And you're going to have to move forward with not knowing everything. And that's very challenging. Now, a lot of investors won't ever get past that. And it was that partner, that ability to trust and diversify into others that actually allowed me to scale. But it's impossible to become the expert in everything.
Yes. And we are at the tail end of the show. The show comes to an end, but the conversation doesn't have to. Time flies when we're having fun. Ladies and gentlemen, boys and girls, Patrick Grimes. Patrick, how can our listeners find out more about you and continue this conversation? There's so much to really get into, and you have covered really good grounds, and we have had a very teachable moment, but also a master class on investment, on passive investing, on real estate, on recession, on rising taxes, on the inflation, all these things. People may have questions. Where do they go to? Some may just want to say, hey, thank you so much for all that you have shared. Patrick?
Yeah, sure. Well, I mean, our website has a ton of content and we're constantly adding to it. Join us on social media and you'll see I posted our latest videos. I have constant Forbes articles, educational webinars. I speak on stages on wealth building and economics and alternative assets, and I do virtual ones as well. And we tend to post those videos up on the site. I'd recommend jumping on Invest on Main Street. Invest on Main and then Street, all spelled out, .com. and you can see it there. If you want to set up a call and you have some interest in investing, investonmainstreet.com/contact. That gets to my calendar, and love to have a chat with you. And if you see any deals on the website you want to chat about, you want to shoot me an email, you can do that as well. Patrick@investonmainstreet.com.
Thanks a gazillion times, Patrick, for your time, wisdom, and for really showing up very, very strong. That website again is investonmainstreet.com/passive investor guide. Just follow the process and then you can get the contacts, can get everything. And they're really active on social media. I want to take that website again, investonmainstreet.com. Check it out. Send an email, send your questions, take advantage of what is there, because Patrick really shares a lot on how you can receive tax advantaged cash flows with limited exposure to the volatility that is there, right? So really take advantage of that. Patrick, coming back to you, what will be your parting shots, your final words? We've had a great time, but also many teachable moments. What will be your last words to those who will hear this show much later, watch this show much later, or those who are listening now, watching now? Patrick?
Yeah, I encourage you to start investing. I think that in this world, with somehow and in some way, and I have my opinions, of course, but in this world, the retirement crisis is really bad, right? People are not saving, and they're not going to have a good experience when they can't retire. And when they retire, their investments dwindle. So I'd encourage you to start. And that's really why we're out there. And that's why I wrote the book, Persistence, Pivots, and Game Changers, Turning Challenges into Opportunities, with some really cool people. I got Phil Collins from the Def Leppard on here. I've got Russell Gray from the Real Estate Guys, some NFL, NBA players. And if you're interested in investing, go to investonmainstreet.com/book. And we would be happy to get you a copy of this. And hopefully it would add to your journey, like it has for others that I've sent it to. And I do sign them, so they're a signed autographed copy of the Amazon #1 bestseller.
Wow, that's very, very nice. Now you can get that book for free. And maybe you can also turn your challenges into opportunities. Find out how they did it, and you can follow the same thing. History leaves clues, and success also leaves clues. You can take on a leaf from there. I want to release you now. I want to let you go now. But you said people should save. Many are not saving. Robert Kiyosaki said something. He said, how can we save money when they are printing it? How can they save money when they're printing so much? And I will not let you go without, please, having to answer that. Patrick?
Well, you can't save and outpace inflation right now. Not with the rate that most people are saving. Actually, I just got an email and I responded to you today. Somebody asking me about the deflation of the dollar, and I sent them some graphs, and it's pretty dramatic. Or the inflation of the dollar, which actually means the devaluation of the dollar. So you really need to invest in assets that are inflation hedged, and that's why we specialize in those kinds of assets that will grow with inflation. Right? Protect yourself from interest rates. And so I recommend investing and searching out what the kind of investments that we've talked about here today, so that you will outpace that, so that that the money in your account won't decrease at a faster rate than you can save. And you'll be in a better position the sooner you get started. Warren Buffett always talks about that compounding interest. The minute you start investing into these ways where it grows faster, then you can start compounding it and growing it faster and faster.
Wow, that's powerful. Thanks a gazillion times once again, Patrick. Ladies and gentlemen, Patrick Grimes. Check him out on investonmainstreet.com. that website again, investonmainstreet.com. Ladies and gentlemen, boys and girls, well done.